Hi, I'm Jamie Turney from Lawrence, Kansas. I'm here to talk to you today about types of policies. The first type of policy we're going to talk about is a permanent or cash value policy. We have 5 different kinds of policies that we're going to go over today. Straight or continuous, limited pay, single premium, modified endowment contract or MEC, and the interest-sensitive whole life policy. A few characteristics of a whole life policy or a permanent policy is this policy will last till you are 100 years old. It's not like temporary insurance where it only lasts for a certain period of time. The coverage and the price can stay the same. However, some policies, those prices will fluctuate, and we'll talk about those. With this policy, there are actually 2 components. One being insurance or protection, and the other component being a savings or what we call a cash value. This policy also provides less protection for more money in most cases, and the money that's in the savings account is actually kept in a general account with all of the insurance company's money. Let's talk about some of the features with a permanent or whole life policy. These features are talking about the cash value and referring to what's happening with the savings in the policy. First of all, there's no money going into that cash or that savings account for the first 1 through the 3rd year of that policy. Secondly, the client or the owner can earn interest on that savings between 2 and 4%. That is a contract rate. That is also a guaranteed interest rate. Also, they have the opportunity to borrow against the savings. They will pay 6 to 8% interest on the money they borrow, and that is determined, of course, by the contract as well. And with the death benefit in a whole life or a permanent policy is only the amount of insurance. So let's say a client has a $100,000 policy, but they've earned $5,000 in their savings or their cash. Upon death, the beneficiary will only receive that $100,000. And then, if the insured does live to age 100, a check from the insurance company will be sent to that client, and it will be in the amount of the coverage that they've been paying for. So let's talk about a few of the policies. First of all, the straight or whole life policy, also called a continuous life policy because you are continually paying your premiums. From the day you start the policy until you're 100 years old, premiums will be paid. Another type of policy is a limited pay. A lot of people say, I don't want to pay 80 years worth of policies. What can I do? Well, let's limit the time you pay. Let's pay those premiums for 20 years, but the policy will remain in force until you're 100 years old. The next type of policy is actually a single premium, and exactly like it sounds, you pay one single lump sum premium, and that policy stays in force, and the coverage is in effect until the client is 100 years old. The next type of policy is called a modified endowment contract, or MEC for short. These policies are like cash value policies on steroids, meaning the cash is very, very aggressive, and actually the government and TAMRA will decide or define if this contract is a modified endowment based on how much that cash has grown over the first 7 years of that policy. If it's too much, by their definition, it is called a modified endowment, and they will take away a few of those tax benefits that the client was receiving before. Also, an interest-sensitive whole life policy deals with what is happening to that interest rate. Remember, the contract or the guaranteed rate is 2 to 4%. But if you want the opportunity to earn a little bit higher rate, what could you purchase? You could purchase an interest-sensitive whole life. These are a guaranteed minimum, the 2 to 4, but you also have the opportunity to earn a higher interest rate on the cash value by looking at what money market rates are paying. So we've talked about in types of policies under the permanent or cash value type, a few of the characteristics, one being that that policy will last till that client is 100 years old, and the death benefit paid is only of the amount of insurance. A couple of the features with the savings is they will earn an interest rate. It's guaranteed at 2 to 4%, but if they want to borrow money from that savings, they're more than welcome to do that, but they will pay 6 to 8% interest on that money borrowed. And then the 5 types, a straight or continuous policy, limited payment, a single premium, a modified endowment, also known as MEC, and then the interest-sensitive whole life. Thank you for joining me.